Hi everyone, welcome back. If you are new here, my name is Patra Francis. I am a tax advisor with over 15 years of experience helping business owners and investors reduce taxes and gain financial clarity. On this channel, I share practical strategies that help you legally minimize taxes and avoid costly mistakes. If you are a business owner or rental property owner, this video is for you. Today, we are addressing a very common situation I see. If you and your spouse own a rental property through an LLC, you may be creating unnecessary complexity on your tax return. One of the most common questions I get is, do we really have to file a partnership return just because we form an LLC? The answer is usually yes, but not always. Let's break it down clearly. Under the federal tax law, any unincorporated business with two owners is automatically treated as a partnership. So, when a husband and wife form a two-member LLC, the IRS generally requires you to, number one, a Form 1065 partnership return and separate K-1s issued to each spouse. That is entirely separate tax filing from your personal return. This surprises a lot of couples. They thought forming an LLC was just liability protection, not to add another tax return. Here's where it gets interesting. Tax law allow something called co-ownership. If a husband and wife simply own rental property directly, tenant in common, and they just maintain and rent it out, they can report the rental income on Schedule E of their joint 1040. No partnership return required, but once you put the rental into a multi-member LLC, you created a separate legal entity, and that's when partnership rule kick in. Some couple may ask, can we just elect qualified joint venture status and avoid filing 1065? Unfortunately, no. Not if the rental is inside an LLC. The qualified joint venture election only applies when the business is owned directly by spouses and it's not operated through a state law entity like an LLC. Once you form an LLC, that option is generally off the table. There is one big important exception. If you live in one of the 9 community property states, married couple may have more flexibility. In those states, you may be able to treat a husband and wife LLC as a single disregard entity for tax purposes. That means you could file one Schedule E instead of a partnership return. But if you live in any of the other 41 states, that flexibility usually does not apply. And the rule becomes very clear. You must file Form 1065 and issue K-1s. So, before forming an LLC, couples should think about this. Yes, an LLC provides liability protection, but it may also create an additional tax return, more bookkeeping requirements, and additional compliance complexity. Sometimes it's worth it. Sometimes it's unnecessary. The key is making the decision intentionally, not accidentally. If you already form a husband and wife LLC and you are not sure you are filing correctly, or you are thinking about forming one and want to avoid surprises, book a tax clarity session below. I will help you structure correctly from the start so you are protected without overcomplicating your taxes.